Happy morning to all. I am Dr. Latha, Associate Professor in the Department of BCom Accounting and Finance. We are going to discuss about some important topics under financial management. We have to discuss the meaning of financial management, definitions of financial management, objectives, importance, approaches, functions of finance, sources of finance, need or requirements of finance, functions of finance manager, and also the role of finance manager. First, we should know the meaning of finance. Any business activity depends on the finance, hence it is called as lifeblood of business organization. All activities are concerned with earning profit, hence finance may also be called as capital, investment, fund, etc. Finance may be defined as the art and science of managing money. It includes financial services and financial investments. The main function of finance in business is procurement of funds and their effective utilization in business concern. Next, we should know the meaning of financial management. Financial management refers to the management of flow of funds in the firm. It is mainly concerned with the timely procurement of adequate finance from various sources, utmost utilization of finance for the attainment of organizational objectives. Therefore, financial management deals with the financial decisions making of the firm. It is an integral part of overall management. Next one, definition of financial management. According to S.C. Kuchel, financial management deals with the procurement of funds and their effective utilization in the business. According to Philiopatis, financial management is concerned with the managerial decisions that results in the acquisition and financing of short-term as well as the long-term credits for the firm. Objectives of financial management. There are two important objectives of financial management, that is profit maximization and wealth maximization. First, we should know the meaning of profit maximization. According to that concept, the main objectives of business is earning profit. Profit is the parameter of measuring the business. Profit maximization is the traditional and narrow approach. It does not take into account the risk and does not consider the effect of earnings per share or any returns to shareholders. Profit maximization is also called as cashing per share maximization. And the next one is wealth maximization. According to that concept, the main objective of business is to increase the wealth of investors. The greater the amount of net present value, the greater the value of the firm. When value of the firm increases, the market price of equity is also increases. Thus, to maximize the net present worth means to maximize the market price of shares. Wealth maximization is also called as value maximization and net present worth maximization. Next, we are going to discuss about the difference between the profit maximization and wealth maximization. First, profit maximization. It is a traditional as well as a narrow approach, but wealth maximization is modern and broader approach. Beneficiary under profit maximization improve the business profit and the business will be benefited. But in wealth maximization, improves the wealth, both the business and shareholders will be benefited. Under profit maximization, value of shares, it may or may not increases earnings of the shareholders. Under wealth maximization, value of shares is concentrate in improving the wealth of the shareholders. Next topic is importance of financial management. First one is financial planning. Second one is financial decision. Third, acquisition of funds. Fourth, increase the value of firm. Fifth one is proper use of funds. And last one is promoting savings. Next, under approaches to financial management, we have the two approaches, traditional approach and second one is modern approach. Traditional approach. Main part of traditional approach is raising the funds for the business concern. finding out the various sources of funds, arrangement of funds through various financial instruments. Under modern approach, estimating the total requirements of fund for a given period, raising the funds through various sources, keeping in mind the cost effectiveness, investing the funds in both long term as well as the short term capital needs. In general, modern approach considers the three basic management decision, that is investment decision, financing decision and dividend decisions within the scope of finance function. Next one is function of finance. We have the three functions. First one is investment decision and second one is financing decision and last one is dividend decisions. Investment decision, it relates to selected of assets in which funds will be invested to choose between the long term assets and short term assets. Decision regarding long term assets is called capital budgeting. Decision regarding the short term current assets is called working capital management. Financing decision. Determine the proportion of equity as well as the debt, raising appropriate amount through available sources, concentrate with financing mix and capital structure. In dividend decision, relates to a retain or distribute profit and its proportions. Selecting optimum dividend policy which maximize the value of the shares and wealth of the shareholders. Sources of finance. Under capital, issue of preference shares and issue of equity shares, we can raise the fund through these two. Borrowings, bank credit, trade credit, issue of debentures and bank loan. Need and requirements of fund. Capital required for a business can be classified under two main categories. Fixed capital for its establishment. Working capital is used to carry out the day-to-day operations. Long-term funds are required to create production facilities through purchase of fixed assets such as plant and machinery, land and building, furniture, etc. Investment in these assets represent the part of the firm's capital which is blocked on permanent basis and is also called fixed capital. Short-term funds are required to meet the day-to-day operations like purchase of raw materials, payment of wages, payment to creditors, etc. These funds are known as working capital. Every enterprise, irrespective of size of the business, needs finance to carry on its operations and to achieve its targets. Functions of financial manager: managing the funds, forecasting the funds, investing the funds and also acquiring the funds. Role of the finance manager: finding day-to-day working capital requirement of the business, collecting on time from debtors and paying the creditors on time, managing the funds, ensuring the satisfactory return to all the stakeholders, paying interest on borrowings and paying lenders on due dates. Maximizing the wealth of the shareholders over the long term, awareness to the latest development in the financial markets, increasing the firm's competitive financial strength in the market. Next, we are going to discuss about capital structure. First, we should know the meaning of capital structure. It refers to the proportion between the various long-term sources of finance in the total capital of the firm. A financial management chooses that sources of finance which include minimum risk as well as minimum cost of capital. Sources of long-term finance are proprietary funds and borrowed funds. Under proprietary funds, we have the three criteria: equity capital, preference capital, reserve and surplus. Under borrowing funds, we have only one criteria, that is long-term debts. Optimum capital structure means is a capital structure at which market value per share is maximum and the cost of capital is minimum. EBIT EPS analysis, that is earning before interest and earning per share analysis. The formula for EPS, that is earning per share, is EBIT minus I, that is earning before interest and tax, minus tax rate into I minus T, that is interest charge per annum minus tax rate minus PD, that is preference dividend, the whole divided by N, that is number of equity shares. Thank you.